Good afternoon. Well, equities had a good week last week. Um, Global equities were up around 3% or so, and this means that they've now recovered almost two-thirds of their losses. And whereas the pattern for the previous few weeks had been up one week, down the next week, following the latest move up, there is now, in a sense, a sort of clear upward trend apparent. That's not the only good news. Last week, we also had signs that the rally in the equity market is broadening out. So far, it's very much been led by a narrow selection of stocks, which have been centered on the big tech stocks in the States. And really, to sort of show more confidence in the economic recovery, you need things to broaden out. And you did see this last week. So you saw some of the more traditional cyclical sectors, which typically benefit at this time of a bull market, they started to perk up. So we had the banks starting to outperform. We also had industrials outperforming a bit. And we had the tech stocks, which, as I say, have led the rally so far, underperforming a bit. So the rally became, as it were, more akin to what you normally see in the early stages of the bull market. Not only that, you had small and mid-cap outperforming last week, and they're typically more sensitive to the economy. And then finally, growth stocks, and by that we mean stocks with high earnings growth projections. They have very much led the rally so far and have done much better than value stocks. And we saw the reverse happen last week. So we saw value stocks actually pick up a bit. And clearly this may or may not be sustained, but it's the difference between, or it's very different from the trend you've seen in the last few months and indeed the last few years. So why is the market looking on the bright side of life? Well, I think number one, lockdowns are being eased. There is some semblance of normality, a normal life being returned. And as yet, we haven't seen a sort of major secondary spike in infections. So it's all good news. And on top of that, in the UK, the sun is still shining. So short term at least, I think this rally could actually go a bit further. And one reason for saying that is that this good news could well continue a bit longer. And also investors who have remained out of the market, in a sense, may be sucked in now for fear of missing out. So short term at least, the market could continue a bit longer. Long term, over the next few months or so, we do still think there are significant uncertainties out there. And just to name a few of these, the most obvious is when these big government support programs, both for individuals and companies, start to come to an end, what happens then? The moment, as it were, incomes are soaring. We had a 10% rise in personal incomes in the States actually last month, and we saw the savings rate shoot up to 33%, all-time high. And this is because obviously incomes are continuing, but no one's got anything to spend the money on. But what happens when, as it were, these government support schemes come to an end and the newly unemployed no longer are getting payouts from the government? That's a big question. Another big question mark is, even for those who have remained employed, do they go and spend these savings or not? So sort of big question marks on that front, which we think could lead to sort of a choppy autumn. Another reason for sort of some caution over the next few months, even if not for the next few days or next couple of weeks, is that equity markets have rebounded considerably faster this time than they normally do. So after 3 months, or actually after just over 2 months, we're up 33% or so from the bottom. The typical gain after 3 months is actually only 20%. So we're well ahead of what you typically see in the early stages of the bull market. And the kind of gain of around sort of 33% we've seen at the moment is akin to what you normally see after 6 months or even a year. So certainly I think there's reason to believe that the further the market rallies up in the short term, the more it's taking away from the scope for further gains later in the year. One final reason for a bit of caution is just equity valuations. What we've got here is the global equity price earnings ratio, and here we're using actually not this year's earnings, but next year's earnings. So we're assuming earnings do recover quite a lot next year. But even if you use next year's earnings as the basis for price earnings ratio, the fact of the matter is that P ratios are back at around sort of 17, getting up to 17 times at the global level, which is pretty close to the highs you saw in the last couple of years or so. And this is despite the fact that, as we've already highlighted, there's still a lot of uncertainty about how quickly economies will be able to recover over the coming year or so. So for all these reasons, we do think even if markets can continue to rally a bit further, any sort of further short-term gains will be at the expense of further increases later in the year, and certainly in the autumn, when, as it were, government stimulus programs begin to run out, there is a danger that we could see a correction. Anyway, those are our views at the moment, and I'll be back again